Hey everyone, PPC Ian here. I have a portfolio update I want to share with all of you today. I spent the last several days going through my portfolio. I have a big spreadsheet. I share it over on my Corner Patreon, which I'll link to in the pinned comment below. It has a lot of columns. I go through a lot of data, and I have 11 insights that I found from my personal portfolio that I want to share with all of you today. Before I get into those 11 insights, however, just a quick overview. As you can see on the screen in front of you right now, those are my top 5 positions. Those top 5 positions comprise 36.71% of my portfolio's value and 41.60% of the dividend income. You will see right away that Johnson & Johnson has claimed the #1 spot again. Altria is in #2. Starbucks has fallen all the way to #3 because that company has been facing some challenging times. You can see British American now up there in the top 5, coming in at #4. That one has performed very well. And McDonald's. I would say for those of you who have been following my portfolio for a long time, the 2 surprises that you see in there are going to be Altria and also British American. Those are 2 new positions to my top 5. And the reason that they're in the top 5 right now is I added very aggressively to those both positions when they were on sale. But they've now rebounded in share price. They've gone up quite a bit in share price. I'm not reinvesting dividends on though. I'm selectively taking those dividends. I'm reinvesting them elsewhere. Some of the dividends I'm using to pay my bills, but I'm not building those positions anymore. Anyway, because I went so aggressive on the SIN stocks when they were on sale, they are now 2 of them in the top 5. And in fact, I want to share some more data. As you can see on the screen in front of you right now, this is a breakdown of the categories in my portfolio. And you can see right there, SIN stocks, 29.9% of my dividend income, but just under 20%, it's at 19.3% of the value of my portfolio. The reason that the dividend income is disproportionate to the value of those stocks is because they're very high yielders. And so they have a disproportionate high yield as compared to my portfolio average, which is actually 3.6%. You can see CPG food comes in really high. CPG, restaurants, I already talked about McDonald's, that falls into the restaurants. Healthcare, that would include Johnson & Johnson, so on and so forth. Now, what I do want to point out here is ETFs is climbing the list, and ETFs has 2 ETFs in it right now, but SCHD, that is the largest holding I have in the ETFs by far. And it's nice to see that climbing in the list. And so recently I was at Blossom Social Investor Tour Chicago and previously Toronto. These were life-changing events for me. I met so many amazing content creators, but also so many of you. You guys showed up. Thank you for being there in Chicago. It was so nice to meet you all. And please put in the comments below if you were there in Chicago. And also, some of you took some photos with me. Please share them on social media. I really want to see some of these photos because I didn't get photos of with all of you on my own phone. And so I want to make sure if you took a photo, please share it. But anyway, one of the themes at these investor tours that kept coming up over and over, and this was coming up from some of my favorite content creators and friends within the finance industry, 2 of them being Brandon Beavis, who was the co-founder of Blossom Social, and also Joseph Hogue, CFA. I got to meet him and even film some content with him that I'm going to share on my channel here soon. But with Joseph as well, he brought this up. There's this concept of the core satellite approach. And so you have your core positions, and a lot of people out there in the investing world, the core positions, sometimes they are going to be ETFs, they're going to be very low risk investments, and then the satellite positions, they might be something else, and some investors may take on more risk with the ancillary or satellite positions. All of these years, I've had a similar strategy. I've called it core ancillary, but the difference with my core, right now at least, is it does not include ETFs. It includes stocks like the 5 that I showed you at the beginning of the video today. But what I want to do is quickly show you through the metrics how I've set up my portfolio, because I have this core satellite approach and it's personified in the numbers. So as you can see on the screen in front of you right now, check it out. So the top 5 positions, as you already know, make up 36.71% of value, 41.6% of dividend income. Top 10, we're all the way up to 61.32% of value. Top 15, all the way up to 76, almost 77% of value. Top 20, 86.54. So you can see I am very concentrated in the top positions. And that makes sense because those are the positions in which I have the most conviction. I have a total of 39 positions right now. And in fact, I'm now at 40 because I added one today. I have that over on my backyard and corner Patreon. It's not in the portfolio update today. I'll be sharing that new position though on YouTube very soon as well. It's one that's going to really surprise all of you. But I want to keep going. I have a lot to share because I haven't even gotten into the 11 insights yet. I'm just going over the preamble still. So check it out as you can see on the screen in front of you right now. The next thing I just want to share really quickly is when I look at my portfolio in aggregate, I look at the underlying stocks. And I'm not looking at reinvestment or net new capital here. I'm just looking underlying what are the companies that I own in my portfolio on aggregate doing? Well, on average, over the last 5 years, they're growing the dividends by 5.25% when I'm weighting by value percentage and 4.66% when I'm weighting by dividend contribution percentage. I think the 4.66% number, honestly, is more reflective of kind of the underlying performance of the companies that I own. The reason that I point this out is, honestly, if I were to critique my dividend portfolio, maybe this is reflective of where I am in my journey. I'm about 6 years away from my goals, and so I'm really prioritizing these days stocks that have a higher starting yield and a slower dividend growth rate. I think in the market overall, dividend growth rates feel like they're slowing, but honestly, these numbers, they're pretty slow. I would like to see them closer to 7%. And so this is honestly why I'm buying SCHD, because it's doing better. The 5-year CAGR on SCHD, which is the ETF, the primary ETF that I own, is 10.38%, but even year over year, it's about 5.8%. And so SCHD, in terms of dividend growth, it's outperforming algorithmically what I am doing manually with my own portfolio management. And overall, the starting yield on SCHD, it's similar to the starting yield on my portfolio. Actually, SCHD has a little bit of a better starting yield than my portfolio average these days. And so just something to keep in mind. I like to look at the numbers and I like to remain humble. I like to critique myself. I'm very proud of what I've built. I have many positions like Altria, British American, which have done very well. I have other positions like SBUX where I've faced more of a setback on that one. It's just been slow to turn the corner with their reinvention strategy, although I have full confidence in Brian Nickel that over the coming years, he's going to hopefully figure things out for investors like myself. It's a forever hold for me as long as they don't cut or suspend the dividend. But that's what it is. This is my story. I'm sharing all of the successes and also setbacks as well. And I have to be honest with the data. I'm very proud of myself where I am. I'm about 6 years away from my goals. If I keep really hitting the gas pedal and going all in on what I'm doing. But that being said, the dividend growth kind of overall, not counting reinvestment, not counting net new capital, it's a little slow these days with the underlying companies in my portfolio as compared to an algorithmic approach like SCHD. Anyway, I want to get in to those 11 insights because these are really cool. Before I do, if you're enjoying the video so far, please go ahead and click the like button. It really means the world to me so much. I'm serious. This helps me. This helps my channel. I really want to grow this channel here on YouTube and beyond. By the way, if you're over on Instagram, check me out as well. I'll include a link to it in the pinned comment below. I'm sharing a lot of reels and updates over on Instagram these days, including some fun photos from the Blossom social events that I just spoke at. Anyway, let's keep going. Check it out on the screen right now. So I got to go quick because I know the clock is running. So takeaway number one, and these are in no particular order. But number one, I'm on track. I look at these numbers to benchmark myself and see how I'm doing. What I'm finding at this point in time is I'm probably going to hit my financial goals in around 6 years as long as I can average 12% annual dividend income CAGR over these next 6 years. Now, what I would say, because we know the underlying securities in my portfolio are not growing their dividends at that pace, is I'm really going to rely on reinvestment and I'm going to rely on capital infusion into the portfolio. Now, I look at the portfolio versus 625.25. I actually do these updates quarterly. So over on Corner Patreon, I have my full portfolio with all 39 positions, and I share quarterly updates. I have the percentage allocation to each position. I don't share raw numbers. I don't share portfolio value. I share what I'm comfortable sharing here, and I believe that this still provides great value for those watching and listening because I do share the percentage allocation of each position and the full portfolio over there on Corner Patreon. Anyway, versus the last update that I did on 625.25, which was roughly 1 quarter ago, my dividend income is up 3.2%. Versus the 327.25 update, which was roughly 2 quarters ago, I'm up 5.6%. If I just take the 5.6% and I double it, annualize it, I'm coming in just over 11% CAGR year over year when I'm looking at the dividend income coming from my portfolio. And I believe I'm going to be able to infuse a little extra capital in December to hit or possibly surpass the 12% number. Look, I'm on that home stretch. I can feel it. I can see the light at the end of the tunnel. That being said, to get there, I will still have to make sacrifices. I will have to keep the pedal on the gas and go all out to get there. But right now, in this moment, I feel good about where I'm at with my portfolio's dividend growth. That was takeaway 1, and that's why I do these numbers. Takeaway 2, check it out on the screen in front of you right now. So the next one that I want to share with all of you is, we've already talked about this, but the sin stocks are huge. The time to diversify is now. I basically doubled down on sin stocks over the years because it's a strategy that's worked for me. And in life and in business, I've always been told, find that one thing you're really good at and then focus at it and be the best at it. Honestly, in the world of investing, sin stocks have been one of the things that I've been the best at. I understand the industry. I analyze the stocks. I know when to buy them. I have, for my personal situation, a level of comfort in them, and they've served me well. But this is the time now that I've focused on the one thing and it's served me well. I need to branch out and diversify because I have a concentration of risk. And if I were to critique my portfolio, that would be one of the first things that I would say is, hey, Ian, you have 30% of your income coming from one industry. And at any given moment, if something bad happens to that industry, well, that could put your income and your FIRE goals, financial independence, retire early, at risk. And so that's something I have to be self-critical of. Let's keep going. As you can see on the screen in front of you right now, the next takeaway that I want to share with all of you today is takeaway 3. This one is fun. How many of you, going back to 2018, remember that at the time, United Technologies was my number 4 largest position? Please put in the comments below if you remember that. Those were the days. But what happened back in 2018 is United Technologies merged with Raytheon. They also spun off Otis and Carrier. And at the time, what I said is, hey, Ian, you're going to go ahead and you're going to manage Raytheon Technologies, which is the new company, with Otis, with Carrier, and kind of look at it as one. You're going to do that because this is your number 4 largest position. You have conviction. You love this company. And that's what I've done. Now, check it out on the screen. This is really interesting here. This is something really interesting because 2018 PPC Ian would be proud. And so what I want to share with all of you right now is Raytheon Technologies right now is my number 7 largest position at 5.86% of the portfolio's value. But when I combine in Carrier and Otis, which I still own to this day, it actually, all 3 combined, comes out to 6.83% of my portfolio's value. That would actually place it in the number 3 position. It would displace a Starbucks. It would place it in the number 3 position. And so overall, PPC Ian of 2018 would be happy. And I think it's important to kind of set these goals in one's investing journey and follow them. everyone's going to have different goals. Everyone's going to have different rules, but these were the goals and kind of the rules that I set for myself as it pertained to kind of that United Technologies situation. And owning the company all these years, it's really served me well. Now, I do think it's probably a little expensive right now. That's what it seems like. Anyway, as you can see on the screen, I got to keep going. I have so many of these insights, but this is number 4, SCHD. I'm pleased to say I'm overwhelmed with joy to say that it made my top 10. So it's now number 10. It's 4.06% of the portfolio, 4.39% of dividend income. The focus is paying off. I want to get it up even higher in the portfolio. I think I can pretty quickly get it to number 8, but getting it better than number 8 is going to require a lot of capital infusion. I'll just keep focusing, but so far my patrons know this on Backyard Patreon and Corner Patreon, brick by brick. I just keep adding brick by brick, and SCHD, it's working for me, and now it's in the top 10, and that gives me a lot of comfort because that's the goal I set out for myself this year, was to build it into the biggest possible position I could. I wanted to get it into my top 5, and it's probably not going to get there this year, but I'm really proud that this is the first time it's been in my top 10. Let's keep going. As you can see in front of you right now, I have more takeaways. So this one's number 5. I would say just diversification works. I've already spoken about this, but Starbucks, it's facing some challenges and setbacks, and it's been a little bit of a drag on the portfolio, if you will. It's been holding the portfolio's overall performance back, not only on a capital appreciation standpoint, which really doesn't matter to me other than feeding my ego, but on the dividend standpoint. They just increased the dividend. It was only 1 penny per share per quarter increase. Hey, something's better than nothing. And of course, I'm going to hold this one for the long term. It's a forever hold for me as long as they don't cut or suspend the dividend. I'm going to share a photo on the screen really quickly. This is just me at Starbucks in Chicago, the Reserve Roastery. This is the largest Starbucks in the world, to my understanding. It was amazing. I had a tiramisu iced latte. It was life-changing. I bought a lot of merch there. It was so much fun. Boy, Chicago, this is like a hidden secret, if you will. I love this city. I can't wait to go back. Starbucks there, I went there 2 days in a row. It was amazing, but that is just an aside. Going back to my dividend stock investing portfolio, diversification works because you'll see in a minute, but not only as I've explained, my dividend income is up, but my portfolio value is up. And the reason the portfolio value is up is whereas Starbucks has not been doing so well, other companies in the portfolio have picked up the slack, and that's why I diversify. And so as you can see on the screen in front of you right now, I want to keep going. The next one I want to share is it's an expensive stock market. I have gone back in time. I've done a lot of these portfolio updates on Corner Patreon, and each time I do the update, I look at just the current aggregate yield on the portfolio. Where is it sitting? Usually it's a higher yield than it is now. What I'm telling you right now, it's at 3.6%. For me, for a portfolio that I'm adding higher yielders to all the time, that has 30% of the income coming from high yielding SIN stocks, to have an aggregate yield in the portfolio of only 3.6%, which is now lower than SCHD. What that tells me is, hey, Ian, we're in an expensive stock market right now. So Ian, just be cautious, beware, there could be a correction ahead. Have a little extra money ready to buy stocks if there is a correction, because just the portfolio's yield where it is, it's kind of low, which means the values are kind of high. And I saw that when I was looking at PE ratios as well. A lot of stocks in the portfolio seem expensive, and I don't sell, but I'm ready. I'm ready for a possible downturn ahead, an adjustment in these valuations, because they just seem really high. As you can see on the screen in front of you right now, the next one that I want to share is takeaway number 7. This one's so much fun. I'm a dividend growth investor. I put growth in all caps. I believe that the numbers personify what this is all about. Yes, my dividend income is up, but what I also want to share is the portfolio value is up. It's up 10% since December of 24. It's up 17.2% since August of 2024. These are some pretty big numbers for a more conservative income-oriented portfolio. Obviously, a lot of the growth is coming from dividend reinvestment, and also from net new capital, but it's also a byproduct of capital appreciation. And so it's just a friendly reminder to those watching that sometimes income investors, we get a reputation that we never see capital appreciation. But myself, as a dividend growth investor, I'm investing in those companies that grow their revenues, their earnings, their dividends. These are growth scenarios. They might not be growing as quickly as some of the cutting edge high-tech stocks, but there is growth potential with the dividend growth investing strategy, as I've seen. So as you can see on the screen in front of you right now, I have another takeaway. This one here is number 8. I just want to highlight some standout positions that have high dividend CAGR. I went through the whole portfolio. The ones right now that are really boosting the CAGR of the portfolio, we already know SCHD, but Home Depot, Caterpillar, BMO, used to be called Bank of Montreal, CARR and OTIS. I'm actively building SCHD, but if I want to kind of push my portfolio CAGR just a little more, I may consider adding a little more BMO. I may even at some point consider adding a little CARR and OTIS, some extra, if they have any kind of weakness with their stock prices. But right now they seem kind of fully valued. I got to keep going because we got more. As you can see on the screen in front of you, the next takeaway right now is takeaway number 9. I would just say tracking progress is key. It took me so much time to prepare all of this, not only for the video today, but for Corner Patreon as well. I would suggest everyone at home do the tracking, do the work, because it is motivating to track the numbers, and also tracking the numbers can tell us where we have deficiencies and where we need to focus. I've noticed a few in my portfolio. One I'm going to speak about in a future video is going to be a deficiency with exposure to tech and AI and how I'm remedying that. That's kind of foreshadowing the stock that I bought today. But I think it's important for all of us to take a deep dive into our own numbers and see how it all aligns with our goals. Okay, takeaway 10, as you can see on the screen in front of you right now, the next one is I'm really motivated to move fast. Just looking at the numbers, also, I'm very proud for what I have, and I'm there. I can kind of see the finish line, but I also feel like, hey, I'm a little behind. I want to be a little further than where I am. And so it's motivation to be scrappy and frugal and just get it done. Every dollar counts, and finding some shortcuts sometimes can count as well. Look, I will never compromise on quality. One of the reasons it's taking me a little longer to reach my FIRE, my financial independence, retire early goals, is one, I'm going for a fat FIRE, if you will. It's a FIRE that includes higher living expenses. Hey, I'm married and have 2 kids, and I support our family. And so there is a lot involved in that. Living anywhere in the United States these days, or really probably anywhere in the world, the cost of living is really high. And so that's part of it. Part of it in my earlier years is I just didn't get started early enough. I was trying too many different strategies. And a lot of those strategies in the early days, I had some expensive learning lessons. And so that's part of it as well. But yeah, I'm just more motivated than ever before to be scrappy and frugal and reach those goals, and I can see them ahead. But with that, as you can see on the screen, there may be some possible shortcuts. Like I said, I could be at the finish line today, for example. If I had a little higher risk tolerance and I went into certain positions with higher yields, it's not for me. I'm a DGI, dividend growth investor, and so my portfolio is built on very high quality positions, in my own eyes at least. But one possible shortcut in takeaway 11 is Pfizer, ticker PFE. That is one stock right now that my patrons know, but I'm on Backyard Patreon and Corner Patreon, I'm actively buying. It's come down in price again. So that's one where I can accelerate my goals just a little bit when I scan my portfolio. And VTRS, ticker VTRS, that's one that I'm planning to add as well. It's kind of on the way. I'm in process of buying it. And I'll be updating all of you on that as well. But sometimes, even though in my portfolio, I'm not going to compromise on quality. One, given where I'm at in my journey, I'm kind of there. Two, I just don't want to take on undue risk. Three, kind of been there, done that. As I said, I've tried some of those strategies in the earlier days and they were more volatile, higher risk. It's not for me. And sometimes they were expensive learning lessons. So I'm going to stay true to my DGI strategy. But sometimes there's some value out there. And it was Altria back in like 2023, 2024. And now I see it in Pfizer, but that is an ancillary position and it does contain a lot of risk, and same with VTRS. Anyway, if you enjoyed the video today, please subscribe to my channel, especially because I have the interview that I did. I interviewed Joseph Hogue, CFA. He's Let's Talk Money with Joseph Hogue. He's Bowtie Nation. I learned from him actually at the event at Blossom that it's not like a clip-on or anything. This is the serious, real deal bow ties. He is the man. He has all of these credentials, like CFA, and he was an analyst in the stock market. He served our country. I can't wait for you to see this interview. So I really hope that you subscribe to my channel because you'll be notified right away when that video drops. Thank you for watching the video today. Before I go, in terms of a full disclosure, I own the stocks mentioned today. In terms of full disclosure, I am long Raytheon Technologies, ticker RTX, OTIS, ticker OTIS, Carrier, ticker CARR. I am also long Starbucks, SBUX, the Home Depot, ticker HD. Also, I am long Caterpillar, ticker CAT, BMO, ticker BMO. I am long SCHD as well, the ETF. I'm long Pfizer, ticker PFE. I'm long Johnson & Johnson, ticker J&J. I'm long Altria, ticker MO. I'm long British American, ticker BTI. I am also long McDonald's, ticker MCD. A lot of tickers today, everyone. I'm long those positions. Also, I am long Blossom Social. In terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market. Please consult your licensed investment advisor before making any financial decisions. Check out the description below for my disclosures and disclaimers. Also, in terms of full disclosure, I am an affiliate of Blossom Social. While it's free to get started with the app, and I will include my link in the pinned comment below, I'm compensated for signups. And by the way, when you sign up for Patreon, Corner Patreon, or Backyard Patreon, that really helps me. It helps cover the operating expenses of this channel. And also, I have aspirations to grow this channel. And I'm kind of in the middle of trying to figure out what my next studio and setup looks like for PPCE. And those are the types of support from Patreon. It helps me make all of that possible. I love you all. I can't wait to see you in the comments below. And I'll see you in the next Dividend Stock Investing video.